Hello and welcome to our webinar tonight. We are going to go ahead and get started here. This is tonight's webinar is on investing wisely and the cash flow killers in U.S. investment property. So without further ado, we'll go ahead and get started. So in this webinar, we're going to discuss 9 different challenges you can face investing in the United States, and we refer to them as the 9 cash flow killers. You know, the purpose of this webinar is to accomplish 2 things. Number 1 is to provide you with value by sharing with you the 9 things that you need to be aware of when investing in the U.S. And number 2 is to share with you how we approach each of those things to mitigate your risk in each investment. I'm going to share with you, I've been selling real estate for the last 15 years. I've been to numerous sales courses over the years. In every course, they teach you the things not to talk about. They say, don't talk about religion, don't talk about politics, and don't tell horror stories of terrible things that have happened in your business. Well, in this webinar, we're not going to cover religion or politics, but we will break one of the cardinal rules of selling. We are going to tell you the worst things about investment property. We may even try to scare you a little. We're not doing this because we don't want you as a client, but because we want you to be an educated client, a savvy investor, one that knows the risks. This is simply so you can appreciate the reward that comes with it. So without further ado, let's go ahead and get started. As I mentioned at the beginning, my name is Mikesell, and I've been investing here in the United States for roughly 16 years. I grew up here. I have invested in 5 states around the country. I've bought over 500 properties, which I renovated, leased, and managed. You know, despite my experience, every once in a while, even I've got caught by the 9 cash flow killers, the things that have hurt my investments. Today I want to share with you one of those experiences. You know, there's no easy way to really share experiences except by showing you how we do it differently here at American Property Partners. So I'll show you the contrast between our experiences and what we do, and sharing with you the intentional moves we make to make sure we're helping you into a sound investment. So if you're able to join us for our last webinar, you may recall us discussing the 3 famous real estate words used by most any person who's ever had a conversation about real estate. I know you've said these words at one point: location, location, location. If you remember, we described this as location within the world, location within the country, and location within the city. Where in the world are you going to invest? Where in that respective country will you invest? And where in that city will you invest? The location has everything to do with your goals. Location is the reason you are on this webinar. Location can determine your financial future, the amount of cash you have when you retire, the caliber of your investments, the quality of your tenant. Location is everything. So let's talk a little bit more about this location. So let's contrast. The picture on the left, which you are probably looking at right about now, that house was built in 2008. It was selling for $74,000. Rental amount was $875 per month, and 3 bedrooms, 2 bath, and it rented in roughly 3 weeks. Obviously, the house on the right, built in 1958, selling at $91,000. Rent on it was $8.5 per month. 3 bedrooms, 2 bath, rented in about 4.5 weeks. 2 houses, same city, similar neighborhoods. So this is a story of 2 houses. So which do you think you would want to buy? What do you think so far? Looking at these houses, which one gives you the better impression? Which one's numbers look better to you? Well, what is your guess? You may have guessed right. If you assume the house was built in 2008, renting for $50 more per month and renting 1 week faster, and selling for nearly $20,000 less was the better of the 2 houses, you assumed incorrectly. Sorry. Let me tell you about these 2 houses. Both of these are real houses. One house sits in a location that is on the edge of one of the worst areas in the city. The other house is a strong area that is experiencing tremendous capital growth right now. You know, there's a large difference between cheap and affordable. There are cheap houses all over, some in small towns, bad neighborhoods, mining towns. You can always find a cheap property. Cheap is different than affordable. A cheap property is pretty much relative to the market. A cheap property is normally indicative of an area that is a lower socioeconomic neighborhood, an area that you will experience more vacancy and more maintenance. So how do you know what location is the right location? Locating the property that is affordable and not just cheap. You know, the signs are the same. The cars they drive, how they take care of their yards. You know, when we're identifying properties for our clients, we ruthlessly consider all of these things. We cannot tell you what you should and should not be comfortable with, but we can tell you the signs of an area that is not doing well. We're looking for areas that are not just areas that homeowners are attracted to, not just tenants. Let me back that up. We're looking for areas that homeowners are attracted to, not just tenants. You know, areas that offer good street appeal, that you would feel comfortable driving down the road, a house that you would feel comfortable looking at and saying, you know what, I think that house is going to sell pretty easily because it is attractive. Location really is everything. You know, we've all heard never judge a book by its cover. Equally, we never judge a property by its picture. We've all hired that contractor. You know, the contractor to do various projects for us. You know, my good friend used to say about contractors is these guys are guys that come late, leave early, and steal from you while they're there. That is maybe a little bit of a pessimistic view, but also one many of us have experienced. We know projects always seem to cost more, take longer than planned. We always know there's something else that is going to come up. You know, handling a renovation when you are there every single day comes with its own challenges. Handling renovations from afar comes with even more challenges. So here's the good news to start out with. When you are investing with American Property Partners, you don't have to deal with contractors. You don't even have to deal with the project. You don't have to sit down through a renovation on a house. All of the houses we sell have already been renovated. You know, however, a renovation to you and to me could mean something very, very different. A renovation to some could simply mean new paint and new carpet. You know, I had a client who bought a property from another group. This is a few years back. This group claimed the house had just been renovated. They renovated it with new paint, new carpet. The problem was the carpet was actually installed over a floor which was actually rotting out. They painted walls that had termites underneath them. How do we prevent this from happening? Well, on every single property that we're involved in, that we source properties on, we obtain building inspection reports on every single one of them. We ask very pointed and specific questions when we're looking for properties that have had more than just lipstick put on them to make them look right. We're asking about the things that really matter, the mechanical items, the heating and aircon, water heaters, roofs. These are all things that will cost real money down the road. These are things that, if they were not handled during the initial renovation, have the potential to really threaten your cash flow. So, knowing the numbers, another cash flow killer. So here's the deal. When evaluating property and the numbers on the property, you're initially looking at two primary numbers: the purchase price and the amount of rent it is generating. These are the first two looks at every single property. You look at these two to determine if you even want to bother looking at the property any further. The reality is if the property is vacant, then it does not have a rental number. It doesn't generate any income. If the property is vacant, there's no way it can have a true and honest income number without income. Everything else is just a guess. How can we possibly evaluate a property that has zero income? Yes, I realize we can all take educated guesses. We can look at resources online, looking at comparable rents, but we still don't know that true and honest number. The fact is, the only way to truly know is to make sure we're buying properties with tenants already living there and or lined up to move in. So why would you buy it any other way? You would never consider buying a property that only had expenses to offer and no income. In every city, the properties we work on with our clients come occupied. The tenants come occupied with the tenants paying rent each month. No one is saying these tenants are perfect or they're going to pay perfectly, but what we know is that they choose that property. They put a bond down that they could lose if they did not perform on paying the monthly income amount. Now and only now do we have a true income number, a real number to work off of, to evaluate all the expenses against, to make sure all of the numbers work. So let's look at the other numbers that matter now that we have income actually coming in on the property. Knowing your numbers. You know, I was recently reading a real estate magazine, and in there it was advertising this 34% annual return on capital investment. And I was reading this and I thought, you know, what an awesome number. Now, I'm not a person that believes just because something is too good to be true that it's not real. You know, I prefer to evaluate each investment for what it is and determine if it's bunk or if it's real. As it turned out, this one was bunk. The 34% was real if you did not factor in the majority of the expenses that were going to be associated with this property. So how do we know? We're bombarded with marketing each and every day of our life. So how do we know what our real net number is? Look, you can come up with all the expenses you want. You can evaluate these investments any way you want. If you believe your spreadsheet, the one that you personally made, is the best creation and the best formula in existence, then go ahead and use it. We're not telling you how to evaluate the numbers. All we ask is that you are consistent with every property evaluation, that you're not swayed by the numbers in the marketing, but you plug every number into whatever formula, whatever spreadsheet, whatever system you're using to evaluate a property, so you're always coming out with what the exact numbers are, what your net return is on that property. If you want to evaluate on gross return, fine. Just do it consistently on every property. Let me share with you how we evaluate investments. We look at the gross return on investment and we look at the net return on investment. If you're used to evaluating gross return in your hometown, then evaluate it on your gross return on investment. If you prefer to evaluate on the net return after all expenses, then you can do that too. You've got to evaluate based on your baseline comparison for all of your investments, not just your U.S. or your Australian real estate investments. You know, you have to have a baseline number that you're working off of. If you have a family member ask you for a loan so they can start a new business and they offer to pay you 5% interest, well, then that's your return on investment. Whether you figure it out to be gross or net, that is your ROI. If you can invest in the stock market and make a 6% return after all your expenses are deducted out, then that is your return on investment. If you invest in real estate after you back out all of your expenses, what are you left with at the end of the year? That is your net return on investment. This is your baseline comparison for all investments. Now you can move forward confidently knowing you are investing your money in the investment that will provide you the highest return on investment with the same balanced risk. It's an apples to apples comparison. So how do we get that ROI number? Well, in order to get that net ROI number, we've added up all of your expenses first. If you're getting financing, we add up your mortgage, your property taxes, which is like your council rates, your insurance, your property management, vacancy expenses or vacancy allocation, maintenance allocation, and whatever is left at the end of the year, that's your cash flow. Once you have your cash flow, you divide that number by the amount that you actually invested to get your ROI. All right, it might be getting late, but we're going to go ahead and go to school with some math here. If you invested $50,000, then you figure that net cash flow amount against your $50,000 invested. Does that make sense? So, for example, if you invested $50,000 and your net cash flow as an arbitrary number is $2,500 per year, and that's 2,500 divided into 50,000 to provide you your return on investment. We run these numbers with you. We run them for you for every single property during the property evaluation process. We run these numbers so we always know your gross and your net return on investment, so you can rely on it, so you can build your portfolio around it. These numbers are imperative to investing, and we take them very seriously. So now that you know your numbers, let's jump into one of the cash flow killers, which is property management. Look, anyone can buy a house. Anyone can renovate a house, mostly. Just about you can find someone to maybe even lease out the house. Maybe it becomes leased out, but property management is the name of the game. We can spend all of this time looking at property management, but property management is one of your expenses where there is a need for a paradigm shift. You know, I'm sure it's tempting when evaluating property to use Australian management fees as a guide, but when you're reviewing available property from American Property Partners, you will see in all properties the management fees typically range from 8% on the low end to 10%. This is very standard in the U.S. You know, these fees pale in comparison to having the wrong property manager. The performance of your property in almost every case is directly or indirectly related to the ability of your property manager. Let me say that one more time. The performance of your property in almost every single case is directly or indirectly related to the ability of your property manager. A property manager determines the tenant who moves in there. They determine the protocol on rent collection, the maintenance, inspections, and in some cases even the caliber of the tenant. You know, we've worked hard in vetting out each property manager and understanding their systems and processes that they have in place. None of them are perfect, but all of them know how to effectively manage rental property. You know, here at American Property Partners, despite our efforts in finding you the right property manager, we believe it's still your job as the diligent investor to manage the property manager. If you are not clear, ask questions. If your property manager is not clear, ask more questions. If there is maintenance, understand the maintenance and what it was for. It is not to be skeptical that something dubious is going on, but merely to keep clear lines of communication open at all times. Property management is crucial to the performance of your property. Time needs to be spent knowing your property manager and communicating with your property manager regularly. You'll get statements every single month from your property manager saying this much money went into your account, this much money was deducted for property management expenses, and here's your statement. You can review that statement. This is your pulse on your property from wherever you're at in the world. This will always tell you exactly the status of your property. If there are expenses on there that you're not sure of, call and ask. If there is something that doesn't look familiar or something that is looking consistent on every statement every single month, call and ask. You can call us, you can call the property manager. We've got a lot of experience working with property managers, but the common denominator with all of our property managers is we find them to mostly be good communicators, particularly when it comes to money. So this is important, and we hope that we've spent the right time on property management. So let's move on. So one of the cash flow killers, I think, is property taxes in the U.S. These are, you know, like I mentioned earlier, like the council rates that you pay there in Australia. These vary widely between states and counties. It cannot be assumed because you are in a certain percentage in one state that it'll be the same in another state. What we find is that there are certain states with higher property taxes. The income on the property will be proportionately higher to compensate for the higher rates. Property tax in each state can change depending on the state every few years as they reassess the value of that property. You know, insurance in the U.S. is similar to what you may be used to. However, we've seen poor insurance decisions turn into great investment great investments into nightmares. So, I mean, you could have a perfectly good investment, and by choosing the wrong insurance, it could change the outcome. You know, I think the insurance policies, there's so much small print as it comes to insurance policies that most people don't even know what they're buying when they're buying the insurance policies. I'm going to share with you, all insurance policies here in the States are pretty standard. There are a few vital things that can be missed on the insurance, like a loss of rent clause, or flood insurance, or not getting flood insurance in a flood zone, or hurricane insurance in a hurricane zone. If insurance was not important, then the bank that you are borrowing money from would not force you to insure it. Insuring your investment correctly is important to your investment. So when getting insurance here, your standard insurance policy will come with what we refer to as the burn down clause. Sounds pretty fancy, doesn't it? This is basically your general liability clause. It kind of catches everything, your proverbial slip and trip. It covers just about everything. You know, 4 years ago, I got a phone call. I was actually on my way into the office and said, "Hello, are you the property manager for this specific address?" And I responded, "Yes, yes, I am." Okay, this is the Charlotte Fire Department. Your house over on River Street started on fire this morning. We believe that the cause was a small fan that actually fell over and overheated and somehow caught a blanket on fire. Now the second level of your home is completely gone." Well, as it turned out, it wasn't actually my home. It wasn't my rental property either. It belonged to one of our clients who we strongly advised when they bought this property to get something that we call the loss of rent clause added onto her insurance. This clause basically paid her the rent she was receiving on this property for the next 7 months it took the insurance company to rebuild this property. As you can imagine, our client was grateful. We were so convincing in advising her to get this and add it onto her insurance policy. You know, the best part of the story is about 3 weeks after the house burned down, the tenant who used to live there called our office and requested we send them back their bond, which is their security deposit. We found this very entertaining, and we simply responded, "You burned down the house, and I don't believe we're going to be returning your bond anytime soon." So the house was not able to be brought back to original condition with the bond, therefore you do not get it back. So moving on, cash flow killers. We're on to repairs and maintenance. You know, repairs and maintenance, this is such an ambiguous category. You know, how much is the right amount to set aside each month? How does one determine or predict how much maintenance or repairs are going to have on a property? Well, first off, with repairs and maintenance, they're two separate words. Repairs, that means the repair of broken items. Maintenance means properly and proactively maintaining it before something goes wrong or when it actually needs it. You know, as it relates to maintenance, a lot of maintenance can be scheduled and planned for. For example, if you know you bought this property this year, and when you bought the property had a brand new aircon installed, then you know you'll not need to install brand new aircon for this house for another 12 to 14 years from now. So you can schedule and plan for this maintenance. However, in 7 years from now, as that aircon is a bit older and does not work quite as well, then you can expect to deal with some break and fix scenarios. You know, as a general guideline, we like to set aside 5% per month for maintenance. I personally like to fund my maintenance account with a little bit of money at the start with every time I buy a property, and then just add my 5% to it each month. That's my personal preference. Then I add my 5% to it each month as a rental income comes in, so I always know I'm prepared for that maintenance call that's going to come in sometime down the road. You know, vacancy is one of these other cash flow killers. You know, nothing hurts more than having a big fat zero income. That's what vacancy is. This is money lost that you'll never ever get back. When a property is vacant, it will already be something you don't want to deal with. However, what makes it tolerable, I guess, is being prepared for it. plan and prepare. All of our rental properties will eventually go vacant. This is just a fact of life. So we need to be ready. For our vacancy, we also like to allow a factor of 5% of the gross rent each month for vacancy. The average tenant stays in most of the properties for anywhere from two years and up. The average time a property is or should be vacant is approximately 45 days. Just planning and preparation and allowance for each line item makes each of these investments a little bit more comfortable and easier to manage for you and for your property manager. So you know, we've covered a number of things tonight that are all the cash flow killers, things that could hurt your return on investment. There are many strategies that we can share with you on working through vacancy, maintenance, choosing properties. We just simply cannot cover everything with you in a format like webinar. You know, what we shared with you, we hope will offer you the largest cross-section of information that will assist you in your investing decision. You know, let me share with you a few of my personal closeout thoughts. My take is this: investing in anything is a risk. There's no such thing as a risk-free investment. You know, if there was, we would all be on that train. Everyone you know would be investing right now if there was no risk. In fact, you know, I'll even take it a step further and say, if someone tells you there is a no-risk investment, run. Run away as fast as you can. There cannot be a return without a risk. It does not exist in any country or in any type of investment. What makes each of you on here listening great investors is that you are taking the time to figure out what those risks are, evaluating those risks, and making sure those risks are an acceptable level for you to warrant the type of return you're wanting that you cannot get in Australia. So, where to begin? And how to get started with American Property Partners. So, make your location decision. Decide you are investing in the U.S. Set up a one-on-one portfolio strategy call with myself or Stephen. Finalize your investment criteria: what quadrant, location, what property type, and identify a few properties that you like and why you like them. You know, from there you'll set up what we like to refer to as a property selection process. This process will go through each property in excessive detail, and then from there, if you're getting financing, then you start the financing process and begin building your investment portfolio. So that's it for our webinar. We have a webinar seminars coming up in the coming months. We hold them somewhat regularly in our offices there in Melbourne, so please check in with us on our website and look into those seminars and these webinars we will be doing pretty regularly, so keep up on these as well. Thanks again for your time and joining us tonight, and we look forward to speaking with you again. Take care. Cheers.